Let's get started as people come along. Welcome everyone. For those who are new, welcome to our session on Singapore, and for those who are recurring as well. We are very happy to be talking today about the Singapore transfer pricing updates for 2025. So this is basically very timely because we are about to start the transfer pricing season in Singapore with a lot of the documentations being due by 30th of November and audits being finished at the moment. Then we basically start kind of officially our peak season and timely to share with everyone what's the requirements for this year. So let me just do a brief introduction for those who are new. We are a firm that specializes in providing transfer pricing, and I will say international tax advice to multinational companies in the Asia Pacific region. We have several offices: Australia, Singapore, Malaysia, and UAE. We have been in business for about 16 years plus, with a lot of accolades apart from consulting, just participating in industry activities as well, and basically just sharing what we know with the industry in general. For those of you who don't know me, my name is Adriana Calderon. I'm the co-founder of Transfer Pricing Solutions Asia and Malaysia, with extensive experience in international tax, starting with the Big Four, then mid-tier firms, and now under Transfer Pricing Solutions, in basically advising multinational companies in areas of corporate international tax across South America, the US, Australia, and the Asia Pacific region. Nevertheless, over the past 16 years, I have been focusing mainly in the area of transfer pricing with a little bit of international tax, and now also a bit thrown in the deep end with our global minimum tax as well. And today I have basically with me one of our most experienced assistant managers who have been with us now. I think it was your 6-year anniversary, right, Lisan? If I'm not mistaken.
Yes, yes.
So Lisan is basically a TP solution brand all over because she has been with us about 6 years. She has advised companies in the area of transfer pricing in Singapore, Malaysia, Australia, with several projects in respect of compliance, planning, audit, benchmarking in industries such as shipping, commodity, electronic, and construction. Prior to Transfer Pricing Solutions, she was in a mid-tier firm practicing corporate tax and assisting clients with tax computation, licensed with Malaysian Tax Authority, and resolving tax disputes. So in her spare time, she enjoyed listening to music and playing sports. But Lisan followed a little bit of a similar path of what I call very traditional path to TP, which is first doing tax and understanding corporate tax, and then specializing in TP over the past 6 years with our firm. So maybe with that, we can literally start with our presentation for today. So we will be talking about the latest IRAS guidance. Then we will be talking about related party forms and tax returns, which is just some compliance matters that one needs to be taken into consideration when it comes to transfer pricing. And then we will open for Q&A. So Lisan, do you mind? I'm sorry, I'm still recording from a small cold, but all good for today, thankfully. So Lisan, do you mind just sharing with us what are the rules and what have been some of the updates specifically in relation to documentation?
Thanks, Adriana. All right, so for the first topic, let's dive into the requirements for preparing a TP docs. It is effective from year of assessment 2019, and taxpayers that meet either of the conditions are required to prepare. Condition A, if the gross revenue is greater than Singapore dollar 10 million, or condition B, the TPD is required for the previous basis period. However, there are also exemptions. in exemption from preparing a TP doc when the gross revenue is consistently below the Singapore dollar 10 million, or there are specified transactions, which we'll look into it in the next slides. And what needs to be prepared: documentation at group level, entity level, and country-by-country reporting for certain taxpayers. And please note that the TP documentation must be updated every year, and taxpayers are required to submit the TP documentation within 30 days upon request from the IRAS. So when we're submitting the tax return, taxpayers are not required to submit the TP doc as well, only if it's upon request from the IRAS. And when it needs to be prepared is no later by the time the tax return is filed, which is 30th November. And based on the latest guidelines, the completion date is now compulsory to be incorporated in the TP doc and the subsequent updates, which includes the simplified TP doc and other names for qualifying past TP doc, which we'll look into this in details later.
Yes, so this is important to note, that last point, Lisa, and thank you for bringing that up, because a lot of clients tell us, well, if IRAS doesn't request, why do I have to prepare and date it? And I think that's where we need to be very clear that the date is important, because these days we don't do electronic submission anymore, physical submission anymore with IRAS. It's always electronic. So with electronic versions, it's very easy to realize whether one is backdating documentations only at the time that the IRAS is requesting, or whether one is doing it really at the time filing the tax return. So far to date, there hasn't been any disputes yet with IRAS on IRAS realizing that the documentation was prepared only when it was requested, which is usually 3 years down the track. But it's good to keep in mind that, strictly speaking, if IRAS finds out that the documentation is not contemporaneous, they have the right to apply the non-compliance fine for every year that the taxpayer didn't prepare the documentation and the subsequent updates. So if it's for several years under compliance, you can be looking at a hefty fine. Lisan, so why don't you just share with us some of the exemptions that we have and what do we have that is new?
Okay, thanks, Adriana. So let's go into the first exemptions, which is the related party domestic transactions subject to the same tax rate. So in this case, if the taxpayer and the related parties are all Singapore entities and they're subject to the same tax rate, then they're exempted from preparing the TP doc. As you can see, the second and third point, these are relatively new. Related party domestic loans entered into prior 1st January 2025, and the lender is not in the business of borrowing and lending. So, and this is new, incorporated by the IRAS, and if it's a related party domestic loan entered prior 1st Jan, then we are exempted from preparing. As for the related party domestic loans entered into on or after 1st January, and both the lender and the borrower are not in the business of borrowing and lending, and the indicative margin is applied, then again, taxpayer will be exempted from preparing the TP documentation. And as you can see as the fourth point, the related party loans on which the indicative margin is applied. This actually, there's a threshold. So if taxpayers' related party loans does not exceed $15 million threshold and they apply the indicative margin, then they are exempted from preparing the TP documentation. Yep. And please note that the threshold for the Singapore dollar 15 million on the loans is not applicable to the related party domestic loans entered into on or after 1st January 2025. Yeah. And for the routine support services on which the 5% cost markup is applied, the routine support services here is considered a low value adding services and tends to be supportive in nature as opposed to services that contributes to the core business operation. And bear in mind, the IRAS guidelines also has conditions for routine support services to meet its definition as well. So please take note of this, because there are certain conditions that taxpayers needs to meet, all right, in order to be qualified as a routine support services. Example would be something like accounts, your finance, IT support, or even your HR. Yep. And related party transactions that's covered by an APA. So this is the example for the thresholds. As you can see, there's really not much of a changes in terms of the threshold for the purchases of goods, the sale of goods, and the provisions of loans. The threshold remains the same at 15 million. Yeah. And for the provision of loans, the 15 million threshold refers to the principal amount of the loan. Yeah. And if you move on to the provision of services onwards, we note that based on the latest guidelines, the threshold has increased from 1 million to 2 million. So these services would include grant of a right to use movable property in terms of your royalty income and expense, leases of any property, your rental, and also a grant of a guarantee. You have also other transactions, which is not part of the 3 items that I've mentioned. It is, for example, payment on behalf, sale and purchase of your assets as well. So all the transactions, if it's not included in the guidelines, you can categorize them as other transactions. So as you can see, the threshold has increased from 1 to 2 million, which is somewhat is a good news for the taxpayers in Singapore. So let's look at examples of whether these companies are required to prepare a TP doc. So Company A incorporated in Singapore has a Singapore dollar of 20 million in revenue for 31st December 2024. The related party dealings are 1 million purchases of goods and 2 million management fee income. So my question is Company A required to prepare a TP doc?
Yep. Do you want me to answer that one? I can answer that one. So yes, assuming that the management fee income is from cross-border and it doesn't have any domestic exemptions, then yes,
Yep.
the
Yep.
company meets the revenue and the transaction threshold specifically for management fee income, not for purchase of goods. But I will be looking first at the revenue, then at the value of the transaction and the type of the transaction.
Yep. So for this case, Company A is required to prepare a TP doc because it exceeded the revenue of Singapore dollar 10 million, which is the condition A, which was discussed in the first slide. And then they are required to prepare the TP doc for the management fee income of 2 million because it exceeded the threshold of 1 million for the services transaction. Yeah, let's go to the second scenario where Company B has a revenue of 30 million for 31st December 2024. The related party dealings are 16 million purchases of goods and 1 million management fee income. So is Company B required to prepare a TP doc? What do you think, Adriana?
Yeah, assuming that the management fee income is associated with cross-border or domestic that is not exempted, then yes. Bearing in mind that Company B will be obliged for 24 because the financial year end 24 is the last year of a threshold up to 1 million. But this Company B, if we change the facts and the financial year was 2025, then it wouldn't be required for management fee income because the threshold went up from financial year in 2025. So strictly speaking, yes, for both. For the following year, if the management fee income continued to be the same value, then it will be exempted. But it meets the revenue and the transaction threshold, and the type of transactions doesn't seem to be qualifying for an exemption.
Thank you, Adriana. Yes. Okay, so let's look at the last example. Company C has a revenue of 9 million for 31st December 2023. The related party dealings are 100 million on loan, 50 million on domestic loans, and another 50 million on cross-border loans. And they also have another 500,000 of management fee income. So in this case, it's a little bit different, not very straightforward, because for this company, Company C has a 9 million revenue, which does not meet condition A. Yeah, but bear in mind, taxpayers either needs to meet condition A or B. So the next question we need to ask ourselves is, if company C is required to prepare a TP doc for the basis period, yeah, for the current basis period, if yes, then we need to assess further, which is the prior revenue in the last two basis periods. If the prior revenue in the last two basis periods is less or equivalent or less than 10 million, then company C is not required to prepare the TP doc. However, if it exceeded, yeah, then company C is required. But is company C exempted from preparing the TP doc for the domestic loan and the cross-border loan? As mentioned earlier, right, for related party domestic loan entered prior 1st January 2025, and if the lender is not in the business of borrowing, or if they entered into on or after 1st January 2025, and both the borrower and the lender are not in the business of borrowing and lending, and an indicative margin has applied, then if company C meets any of the requirement in B and C of the specified exemptions, then company C is not required to prepare a TP doc for its domestic loan. Yep. And for the cross-border loan of 50 million, we have another exemptions which says the related party loans in debts. If taxpayers applies the indicative margin for loans not exceeding 50 million, then they're exempted. But in this case, the threshold is 50 million, and therefore company C has no choice but to prepare a TP doc for the cross-border loan transactions. For the 500,000 is because it's below the threshold of 1 million for service transactions. Therefore, company C is not required to prepare TP doc for the management fee income.
I think another thing to keep in mind here is that if this company was always with 9 million revenue, let's say that the prior year was also 9 million, then the company actually will not be obliged to prepare documentation because the first threshold that you look at is revenue. So, but in your, like how you were explaining earlier, if for the prior year it was required and there was only, for example, prior year revenue was 20 million, and then this current year, which is in the example 23, it happens to be dropping to 9 million, then the loan thresholds will still exceed. So as you said before, it will still be required to prepare documentation. But the point here is that in the three examples is that you always have to look at first the revenue, which is the condition one, then condition two, whether it was prepared for the prior year, and then the thresholds of the transactions. And then in this case, it complicates matters a little bit more because we have cross-border and domestic loans. So, Lisan, I think one of the things that we get asked a lot in Singapore is a lot of people tend to believe that Singapore follows the rule of updates every 3 years. So can you share with us, is this true or is it just a general confusion?
Thank you, Adriana. All right, so the next topic we'll look at is the yearly updates. So as mentioned earlier, that taxpayers are required to prepare the TP documentation is required to prepare TP documentation, and it needs to be updated annually. However, is there any concession provided by IRAS to do a simplified? The answer is yes. Okay, so for the simplified TP doc, right? In order to reduce the tax compliance burden, yeah, so IRAS has actually provided a concession for taxpayers if they meet certain conditions in preparing a simplified TP doc. So let me just go through very quickly, and I'll go through what are the conditions are in the next slide. When there are no significant changes to the control transactions, and taxpayers can actually use the TPD previously prepared to support the transfer prices in the applicable current basis period, meaning to say, and for the third point, TPD prepared in year 1 can be used for year 2 and year 3 if it meets the condition of a simplified TP doc. Okay, let me expound on this further. So let's say a taxpayer in Singapore has prepared a fresh TP documentation in year one is a full TP doc, yeah. And then after we assess the conditions, if it meets the condition of the qualifying past TP doc, taxpayer can actually prepare a simplified TP documentation for year two and the subsequent 2 years, basically, yeah. And bear in mind that this simplified TP documentation is only applicable for 2 basis period. So that's why in the third point, you will see a new TPD is required to prepare in year 4, which is a new full TP documentation, as opposed to a simplified TP doc. And the last point here is simplified TPD in lieu is that the declaration that the qualifying TPD is available and a copy of the qualifying TP documentation. Let's go to the next slide on the conditions, on what is the condition that needs to be met by the taxpayers in order to prepare a simplified TP doc. The first thing is the taxpayer's transaction has to be the same. So for example, in year one, you enter into transaction A and make sure in order to be qualified, it has to be the same transaction A for year 2 and year 3. Same transactions entered with the same related parties. So I have to make sure everything is the same, especially the control transactions and your related parties. And the compliance matter, this one, it has to be contemporaneous because now IRAS expect taxpayers to incorporate the completion date in the simplified updates as well. And that's to prove that TP, the simplified document, is contemporaneous and is in English. Yep. And the relevant information on the control transactions remains relevant in terms of the pricing policy and also your commercial and your financial reasons for entering into the control transactions. Make sure there are no changes because if you enter into the same transactions with the same related parties, hence your pricing policy should be the same. And your financial and your commercial reasons for entering into transactions should be the same as well, as long as there's no significant changes. Yeah. And last but not least is the annual testing of the arm's length principle. Let's look at the next slides on some of the examples of whether if company A is eligible to prepare a simplified TP doc. So company A distributes product X to company B, its related party, and company A prepared a TP doc for YA23 for the distribution transactions. In the same year, a benchmarking was prepared and company A has been remunerated on an operating margin OM of 3% based on the benchmarking studies. So in the 2 subsequent basis period, which is YA24 and 25, company A can use the TP doc prepared for YA23, including the financial analysis if the TP doc is a qualifying past TP documentation. Now, what happens in YA24 and 25 if the company distributes product X and Y? Remember, the first condition is it has to be the same transactions. Because there's a change in the product, which is the additional new product, which is product Y, therefore, company A is not eligible to prepare a simplified TP documentation. And what if, right, in the 2 subsequent basis period, the company B decides to distribute to another new related party, which is company C? Again, the second condition is it has to be entered with the same related parties. Because there is a change in the related parties, which is the new related party company C, this makes company A not eligible to prepare a simplified TP documentation. And the last question is what happens to the OM if it's fall outside the range for 24 and 25? And one of the last conditions is the annual testing of the arm's length principle. If the OM of the company has changed and is not supportable, then company A is not eligible to prepare a simplified TP doc because we can safely assume that there is changes in the products, which is the transactions, and also in the related parties. And hence, maybe the pricing policy may have changed as well. Yeah. So based on all these 3 points, company A is not eligible to prepare a simplified TP doc. So what are the key remarks of a simplified TP doc? Basically, the conditions remains the same, except the only key changes is that taxpayers are now required to incorporate the completion date in the QPTPD as well, which is the simplified TP doc. It is expected that the qualifying past TP doc ready by the lodgement of the tax return, which is 30th November And if it's not ready, taxpayer can get a non-compliance fine imposed by the IRAS.
Thank you, Lisa. And I think the reason why people get confused is because the tax guide says in one summary chart, I believe is paragraph 6.2, that there is a paragraph and there is a table with a summary, and that summary says that it can be refreshed every 3 years subject to qualified TPD. But then when you read the qualification on or the document on qualified TPD, it actually says that it has to be every year. So this is something that we have feedback IRAS that they really need to erase that point on refresh every 3 years, because it's very confusing and it's actually inconsistent with the Income Tax Act. The Income Tax Act actually said that it needs to be updated every year. So let's talk about the intercompany loan changes. I think this has been one of the big changes that started from 1st of January 2025. And I guess in terms of the principle of how to approach loans, that hasn't changed significantly, in the sense that we still be looking at making sure that the loan is a loan for domestic law purposes. So in other words, when I'm implementing an intercompany loan, I have to have clarity on the substance of the transaction. Ideally, I should have a contract, and then I should have some level of analysis to support the interest rate. And the starting point in loans will remain the same, which is basically that I need to make sure that that loan is a loan for domestic law purposes, because if it's not loan for domestic law purposes in Singapore, then we are really not looking at a loan, and then there is no tax implications out of it. So once I know that the loan is a loan in substance, then we talk about the tax implication and the transfer pricing implication. So this approach hasn't changed. There has been some updates in the tax guide associated with giving more explanation on how to address loans in substance versus equity in substance. But the principles have always been the same, that the substance of the loan will be determined by the clauses of the agreement. Now, the change that has happened is in domestic loans. Basically, before domestic loans entering before 1st of January 2025, used to have a different approach to what we have now. So if the lender is not in the business of borrowing and lending, that basically domestic loan will be exempted from transfer pricing documentation, because the interest restriction on lending will apply. So there was a domestic rule that will apply an interest restriction deduction, and then there wasn't any need to go into the transfer pricing territory. When the lender is in the business of borrowing and lending, then the arm's length rate will apply, where the principal value of the loan does not exceed 15 million. We can use the indicative margin. So there was an exemption from transfer pricing documentation if the indicative margin is applied. Otherwise, transfer pricing documentation is required to substantiate the arm's length interest rate. This is up to 1st of January 2025. Domestic loans entering into on and after 1st of January 2025 will have a different treatment. And I guess what IRAS is trying to make sure is that there is less interest-free loans for the time being domestically, given that that seems to be an area of concern that give rise to tax leakage. So if neither the lender nor the borrower are in the business of borrowing and lending, the arm's length interest rate or indicative margin applies as an arm's length interest rate. The value of the loan limit for the indicative margin does not apply. So for cross-border loans, we will see it, the indicative margin is limited to loans 15 million. So in other words, low value loans. But for domestic, from 1st of January 2025, it can be used regardless of the value of the loan. So transfer pricing documentation will be an exemption if the indicative margin is applied. Otherwise, transfer pricing documentation is required to substantiate the arm's interest rate or substantiate the interest-free position. This is a good clarification, because if the position is basically that if the domestic loan doesn't apply the indicative interest rate, that means that the taxpayer is deviating from what IRAS is expecting. And if the taxpayer is deviating from what IRAS is expected, then what it needs to happen is that the taxpayer needs to prepare documentation, whether it is to substantiate a different interest rate or to substantiate an interest-free position. When either the lender or the borrower of both is in the business of borrowing and lending, the arm's length interest rate apply, or where the principal value of the loan does not exceed 15 million, the indicative margin can apply. So there is a different treatment here because the indicative margin is limited, similar to cross-border, to 15 million loans. Exempt from transfer pricing, these type of loans are exempted from transfer pricing documentation requirements if the indicative margin is applied. Otherwise, transfer pricing documentation is required to substantiate the arm's length interest rate. Cross-border have actually remained the same. Basically, arm's length interest rate applies, or where the principal value of the loan does not exceed 15 million, the indicative margin may be applied. And in this case, exempted from transfer pricing documentation requirement if we use the indicative margin. Exempt from transfer pricing documentation if the loan received or provided are below 15 million threshold. Otherwise, transfer pricing documentation is required to substantiate the arm's length interest rate, including interest-free positions from a TP point of view. So let's see the example here. So if I have a cross-border loans, a series of cross-border loans over here, company A, the channel funds to company B in Singapore, and then company B to company C. So because this is cross-border, then I need to basically first understand the value of the loan. If the loan is below 15 million, then I could potentially apply the indicative interest rate, because the indicative interest rate is for low value loans, obviously taking into consideration that this indicative interest rate is mandatory only in Singapore. If the loan is above 15 million, the chances are that I need to prepare documentation, assuming that my revenue exceeds 10 million. Whereas if I look at the cross-border here, I will have domestic here, I will have that is this loan was entered before January 2025, the domestic interest restriction applies. But if this loan continue or comes into existence at 1st of January 2025, then I'm obliged to charge the indicative interest rate if I'm not in the business of borrowing or lending. Otherwise, I will have to prepare documentation. So that's because then I will be deviating from IRAS view. The concession is that in domestic, I can apply indicative interest rate more freely because I don't have the value restriction. So that's basically the difference in treatment when it comes to cross-border versus domestic. If I have interest-free positions in both scenarios, I also need to prove to IRAS as to why it is okay to have interest-free positions, because their default view is that interest-free positions are not at arm's length. And you have to prove IRAS otherwise. So, Lisa, do you want to share with us some of the points on pass-through costs versus services, please?
Sure, Adriana, thank you for that. All right. So for a pass-through cost is also known as a strict pass-through cost. This scenario arises where the group service provider that may pass on the cost of the acquired services to its related parties without any markup. So in other words, it's a recharge of cost to its related parties. And of course, for it to meet the definition of a strict pass-through cost, it has to meet the following conditions. So condition number one is that the acquired services are for the benefit of the related parties, and it has been charged at arm's length. The group service provider is merely a paying agent and does not enhance the value of the acquired services. And last but not least, the cost of the acquired services are the legal or contractual liabilities of the related parties. So based on the latest guidelines, right, The written agreement on this, that represents the legal or contractual liabilities, now also includes email correspondences. So in other words, IRAS now accepts email correspondences as part of a written agreement. The email correspondences can be either in a single email or separate emails. So as long there's an email between the group service provider and the related parties, it can be considered as a written agreement by the IRAS. So let's look at the example of whether company A meets the definition of a strict pass-through cost without a markup. So company A enters into a contract with the third-party software providers. Yeah. And if you remember the four conditions, and of course, the third-party service provider is to provide services to the group of related companies. So if you remember the four conditions, condition number one is that the acquired services are for the benefits of the related party. And in this case, yes. And number two, the acquired services has been charged at arm's length price. Because company A entered into a contract with the third party, so the price charged by the third-party software provider is considered arm's length because it represents a market price. It's a third-party price. And also for condition number three, in this scenario, company A, of course, acts merely as a paying agent for the group, right? And it does not provide any value-added services for the services provided to the group of related companies. And so it meets condition number three. So condition number four, that the cost of the acquired services is actually a legal or contractual liabilities to the related parties, which is in this case, yes, because the services has been provided by the third party, and there's definitely assume that there is a contract or a legal obligation for the related parties to pay the group service provider in entering into this contract with the third party. So any written agreement between company A and the group of related parties, including the email correspondences, then yes. So based on this example, company A's acquired services meets the definition of a strict pass-through cost. In other words, company A can recharge the cost incurred by the third party and passed on to the group of related companies without any markup.
Yeah, so I think the laxing of the requirement of not having a written agreement, but just having an email or something to support that it has been done on the benefit of the group entities is a welcome one, because in theory, that's how it happens. I think not having an agreement should not be a reason for not allowing for the a strict pass-through cost. So a few other topics that were addressed in the e-tax guide that was released was government assistance, which is basically who wants to address the point of who can keep the benefit of government assistance. Government assistance understood as monetary or non-monetary. The most common ones are grants, subsidies, tax deductions, or investment allowance. So I think the reason why this has become an issue is because sometimes there is a tendency to believe that if there is a grant or a subsidy, particularly in Singapore, with associated with employees, then that can be set off against the other expenses to calculate the intercompany charge that I'm going to do on services. And what the tax authority is saying is that that's not something that they will entertain. They believe that the grant or the salary should be staying in Singapore. So for example, if we have a company A in UK that pays a service fee of net cost plus a markup to a Singapore company B, then Singapore company B receives a grant or a subsidy for a salary. So the question is, can I net off the grant out of my employee expenses and pass the net amount to company A because I receive a grant? And I think IRAS has been quite vocal to say that that's not allowed. It should stay in Singapore, and therefore it should not be net off. Another topic that they brought also, which is less common in TP in the sense that not very frequent one will use or do capital adjustments. But essentially the point here is that any working capital adjustment needs to use generally an interest rate. And that interest rate is where the new guidance have been basically come in to say that basically the interest rate that one needs to use when it comes to working capital adjustments is the interest rate of the tested party, not the indicative margin, not other type of interest rate. The starting point should be the interest rate of the tested party. And if that's not available, then external interest rate. And if that is not available, then you might use the indicative interest rate. But we have to follow that basically approach. So just for information here, if the tested party core working capital is minus 55% and the comparable working capital is 13.67%, there is a difference. And then because the difference is quite significant, which is minus 68.65, one has to adjust the tested party. And the way you adjust it will be by determining what's the tested party cost of debt, which is 3.34%. And if we follow the new guidance, you have to look first at what the tested party cost of debt is. Then external, then the indicative interest rate. That's why I didn't use the indicative interest rate here. So I multiplied the cost of debt of the tested party times the difference, and that will give me the working capital adjustment. The key is basically to always follow the interest rate of the tested party rather than any other interest rate if available. So, Lisan, can you just walk us through some of the issues around disputes and audits and what has been changed?
Thanks, Adriana. All right. So how does IRAS actually ensure TP compliance? And of course, first things first, it will have access to the TP documentation prepared by the taxpayers. And from there, IRAS will actually review and assess if there's any issue with the arm's length pricing. The second way that IRAS ensures TP compliance is through the related party forms. This form is actually included in Form C of the tax return. Yeah. And through this form, IRAS also can assess the TP risk that enforce the arm's length principle. This one, Adriana will talk about it in more details on RPT forms later. And of course, another way to ensure compliance is to conduct a transfer pricing audit. And the resolution to resolve the TP disputes or audits is either through the mutual agreement procedure, which is a MAP, or an APA advanced pricing arrangements. So let's look at some of the key changes in TP audits. Number one is the audit process amendments. This is in relation to the adjustments and surcharges. So based on the latest guidelines, IRAS will consider making an adjustment if they find that if the profit is understated or the loss is overstated due to a non-arm's length pricing. And once the adjustment is made, IRAS will automatically subsequently impose a surcharge, all right, without going through the taxpayer. And if the taxpayer does not agree with the surcharges made by the IRAS, they will have to follow the IRAS objection and appeal process. If we looked at the earlier edition, which is the 6th edition, before IRAS make a surcharge, impose any surcharges, actually IRAS will allow a discussion with the taxpayers to discuss on how to resolve this issue before IRAS impose a surcharge. So the difference here is the taxpayers are no longer given the privilege to discuss with the tax authority in regards to the surcharges. And because of this, IRAS is very strict on imposing of the surcharge right now. So it's more difficult for the taxpayers now. They just have to, if they're not happy or not agreeable, they would have to follow the appeal processes as per the guidelines. Yeah. And the second of all is the MAP process has been simplified through the removal of the pre-filing meeting. And if you look at this chain of submission, it's just basically talks about what is the process of the TP audits. So first of all, is the submission of the TP documentations, and then is the evaluation made by the IRAS on the TP docs and other information required, and there'll be a review and negotiation between the taxpayers and IRAS. And last but not least, there will be an implementation of surcharge if IRAS finds out that the control transaction is non-arm's length. Yeah. And another thing,
Sorry.
Yeah.
Yeah, continue.
For the fourth point is the surcharge remission for good compliance record. So in this case, IRAS actually allows a partial or full remission for good compliance record. So and it has to meet three conditions. Yeah, but based on the latest guidelines, IRAS actually expounded the definition for good compliance record to include no history of surcharges or penalties being imposed, remitted, or compounded. Yeah, so it's a little bit difficult now for taxpayers to apply for the surcharge. They must not have any history of surcharge penalties being compounded. Yeah. And last but not least is the self-retrospective upward adjustments within the 2 years of the tax return. So similarly, a full surcharge also can be granted to taxpayers who voluntarily disclose non-arm's length control transactions and make initiative of the self-upward adjustments, provided the adjustments are made within the 2 years of the tax return tax filing due date, and the taxpayers have not received any IRAS notification or queries on the commencement of the audit of the controlled transactions. Yep. So let's look at the TP audit process in a simplified manner. There's actually 3 phases. Phase 1 is the fact-finding and discussion, wherein in this phase, IRAS will request for information and documents before the first meeting, and they will actually conduct interviews to the key business personnel during the first meeting. And IRAS would request for more documents or information to assess if taxpayers' TP doc is adequate and if it has any TP issues. After phase 1, it will be phase 2, which is the completion of review. In this phase 2, after conducting the review of the TP documentation and the relevant information, IRAS will suggest to taxpayers on how to improve their TP documentation. And IRAS will also comment on whether the TP method is appropriate and if the prices are at arm's length. And in any cases, IRAS may make a TP adjustments and impose a surcharge accordingly. And finally, in phase 3 is the outcome. A formal notification will be issued by IRAS on the TP adjustment and surcharge if they found out that the control transactions are not at arm's length. Yeah.
Thank you, Lisanne. So just a quick summary of all the changes. So the increase of the threshold for mandatory TP documentation for the following transactions, services, guarantees, right to use movable property, lease of property transactions, and any other. The domestic loan required to apply interest rate as per the arm's length principle. There is the new treatment of government assistance, additional guidance on a strict pass-through costs, specifically associated with the requirement of having a written agreement, and some flexibility on that. Additional frequent asked questions on working capital adjustment, specifically addressing that the interest rate that needs to be used is the interest rate of the tested party. Additional frequent asked questions for the qualifying past TP documentation, which is essentially making sure that it is clear that this has to be prepared every year and dated every year for non-compliance. Some changes on the simplified MAP process and surcharge remission, and the possibility of doing self-initiated retrospective upward adjustments with no surcharge up to 2 years. Upward adjustment means increasing your tax position, not claiming back tax from IRAS. It is good to keep in mind what do we have for related party forms and tax returns. So basically what we lodge before IRAS is the related party form, which is basically what IRAS uses as a risk assessment tool to snapshot the company's transfer pricing position, and in essence, make sure that it can select certain companies for transfer pricing review. It has been enforced since financial year of assessment 2018 as part of Form C. Now, what do we have in the forms? That now we have more granular data associated with each of the transactions and each of the countries that the company transact with, because one has to basically report all the amounts of related party transactions as reported in the income statement, but a little bit more granular, including domestic and cross-border. And the threshold also includes year-end balances of loans and non-trade amounts. So any taxpayer with related party transactions, both domestic and local, have to prepare a TPO related party form. And for these threshold ones uses the single entity account as opposed to consolidate. So that's why in our experience, a lot of companies do actually end up having to complete the related party form. And that will be basically declaring the transactions with IRAS, and that would be the basis for picking up for audit. There is two exemptions, which is taxpayers that submit a simplified Form CS and dormant companies. And this is how basically the related party form will look like, have to give some information about the ultimate holding company and the territory, very granular. This is the important part, very granular income and expenses transactions per category of transactions. And also the top transactions with foreign countries, plus the having to report also the loan balances and trade amounts. So this is basically what we were saying at the beginning, that IRAS will use as the basis to pick up taxpayers for audit. So in our experience, what happens is when you receive a letter from IRAS, what it will have is the transactions that they spotted as risky out of the related party form together with the audit financial statements, and that will be the starting point on any audit. So one can assume that anything that is reported in the audit financial statements and the related party form may be subject to audit if IRAS consider that the transaction is risky. So with that, let us open for questions. There is quite a few questions that we have. So let us start one by one. So the first question is how to calculate the loan threshold. Is it outstanding balance as of the date, or is loan given or availed during the year? So if there is a loan agreement, is based on the loan amount committed, right, Lisan? The amount committed, not the drawn down value. But if you don't have loan agreements, then the best option is outstanding balances. If a borrower, there is another question over here. If a borrower and lender are in the business of borrowing and lender, will this exemption not apply? Are you talking to domestic or cross-border? I believe, and before or after? I think before it will not apply. After also wouldn't apply. Correct, Lisan? That if it's domestic, and remember that this exemption is only for domestic only.
Domestic related party loans, yes.
Yeah, only domestic. So if it is in the business of borrowing and lending, yes, the exemption will not apply. What if there are multiple loans or additions? So this is a good question because I don't know if this is what you're trying to say, which is basically multiple loans, you have to assess them in aggregated basis for the purpose of threshold for documentation. But for the usage of indicative margin for cross-border 15 million, you have to assess them individually. Now, I don't know what you mean by additions, but there is one point here, which is a practical issue in Singapore. It's like what is considered a loan entered from 1st of Jan 25th and what is not. So when there is a loan agreement, it's very easy because basically we know that the loan agreement that was entered before 1st of Jan 25th is considered prior Jan 25th. But when you don't have loan agreements, what IRAS has said is that in the absence of loan agreements, the loans that continue to be outstanding after the financial year in 2024 may be deemed as automatically being renewed 1st of Jan 2025 because IRAS doesn't have any other way to assess the whether it was entered prior or not. So that's why this is where the loan is important. There is another question here, Lisanna. I don't know if you know this one. What is the indicative margin for 2025?
What is the indicative margin?
Yeah, so I think one thing to keep in mind is that the indicative margin is published by IRAS every year in January. I think for 25th is 1.75, if I'm not mistaken.
Yeah, it's quite low as compared to the prior year.
Is it 1.75 or 1?
1.7.
Okay,
Yeah,
1.7.
it's lower.
So this is something that is applied every or published every year by IRAS in their website. This is another question that the person says, for the surcharge remission, no history of previous penalties. Does it mean from the date of incorporation or for the past number of years? So there is no clarity in the e-tax guide unless you, or do you have any other view, Lisa?
Okay, thanks, Adriana. I'll take this one.
Yeah.
Based on the latest guidelines, right?
Yeah.
The no history of surcharges is actually applicable for the current year and the immediate 2 preceding years, which is the
Oh.
2 years prior. So it's
Oh.
not from the date of incorporation. Yeah, it's for the current year and the immediate 2 preceding years.
Oh, okay. Okay. Thank you.
No problem.
Does it mean that interest-free loans, regardless of domestic or cross-border, is not encouraged from a TP perspective? Yes, correct. Correct. IRAS seems to be quite focused on not allowing interest-free loans. If the company revenue is below 10 million and the domestic loan is less than 15 million in AY 2025, the company is required to prepare documentation. Actually, no, if the loan uses the indicative margin. Yes, if the loan doesn't use the indicative margin. But it can be exempted under the value threshold.
Yep.
It's just that if you are not doing interest rate at all, then you might also have a problem because you might be required to prepare documentation to substantiate your interest-free position. So I think in this case, which the revenue is below 10 million and the domestic loan is less than 15 million, if you're using the indicative margin, then no. But if you're not using your indicative margin, you are encouraged to prepare something because then you have to prove IRAS why you adopted a different approach. There is another one here, which is assuming the pricing policy and related parties do not change since the date of incorporation, can we use the same TPD and just update the financial figures on yearly basis? Is there a new transaction? We will just include additional paragraphs to explain the transaction with justification. I think here, the person who is asking this question, you have to understand that the TPD requirement is not based on the incorporation of the company, is based on when you exceeded for the first time the revenue. You want to explain this further, Lisa?
So as mentioned earlier, one of the requirements to prepare a TP doc is when your gross revenue, the condition A or condition B. So in this case, assuming the pricing policies and related parties do not change, assuming for year 1, this company needs to prepare a TP doc, okay? So subsequent 2 years, if there's no changes in the policy, the same transactions has been entered into with the same related parties, and if it meets the condition of the simplified TP doc, then this company can actually prepare a simplified TP doc for the 2 basis period, okay, which is year 2 and year 3. So what if, all right, in case there's a new transactions, we will just include additional part? No. If there is a changes in the transactions, right, then it does not meet the condition of the simplified TP doc anymore. And therefore, this company is required to prepare a TP doc in that relevant year because there's a change in the transactions. Yep.
For cost sharing, like accounting system costs, is this also not subject to markup for TP and can be treated as pass-through costs? So I think it depends of whether you're using the accounting system as part of your share accounting service. So if you are providing internally a share accounting service, so you have share accountants for the group, and this cost is part of the cost base associated with this share service, then you might have to put it as part of the service and therefore a markup. But if it is just a pass-through because, for example, you acquire a license, but each company has their own accountant, then you can just pass through because it will be just, as Lisan example, a global contract that is being shared among the entities of the group. Okay, I think we are pretty much reaching the 3 o'clock. We appreciate if everyone could follow us on our social media channels. We have a few webinars coming, one in 11th of September and another one on intercompany loans specifically. We have a channel where you can see a lot of the material that we do on ongoing basis, and you can find our details also here. And with that, Lisan, thank you very much for sharing your expertise today. And I hope you enjoy it as much as I did. And I hope everyone also enjoyed the session. Thank you very much.
Thank you, everyone. Thank you. Bye.
Bye.